This is the second PowerPoint that relates to Chapter 4 in Dubnik. So we're going to kind of go back and talk about a few topics that I covered in Chapter 1, in the first PowerPoint, in a little bit more detail. We talked some about the differences that exist between IFRS and US GAAP, but we're going to go into the types of differences a little bit more in this PowerPoint presentation. Second learning objective, describe IFRS requirements related to the recognition and measurement of assets, specifically property, plant, and equipment, leased assets, and inventories. We talked a little bit about recognition and measurement practices between IFRS and GAAP last PowerPoint, and in this I'm going to focus some on property, plant, and equipment. We're going to talk about revaluation, we're going to talk about impairment, and then finally we're going to talk about investment property and biological assets, how they differ from PP&E under IFRS, and what special rules govern their accounting treatment under IFRS, and how that differs from US GAAP. So, recognition and measurement differences. Okay, when we talk about recognition, we're talking about when something gets recorded in the financial statements, whether it gets recorded, how it gets recorded, and when an item is recognized or recorded in the financial statements. When we're talking about measurement differences, we're talking about the amount that gets recorded initially, but also what gets reported in the financial statements. So we talked a bit about fair value and some of the other measurement bases in the last PowerPoint. Some of your options are fair value, net realizable value, amortized cost, historical cost, and lower of cost or net realizable value. So in terms of the types of differences between IFRS and US GAAP, one of the ways in which they differ has to do with alternatives. So in some cases, one set of standards may specify one method where the other allows for the choice between different methods. So one example that we talked about here was with regard to inventory cost flow assumptions. The alternatives available under US GAAP are different than the alternatives available under IFRS. So specifically, IFRS does not allow the use of LIFO. We also talked a little bit about the idea that in some cases, one set of accounting standards might require a method where another might give a choice, where it's either required or allowed in some cases. Typically, IFRS is going to be a lot less lengthy and a lot less detailed than US GAAP. So there are a number of topics for which IFRS lacks specific guidance or requirements. In the last PowerPoint, we talked about differences in financial statement formats, and we also talked some about differences in disclosure requirements and about how GAAP generally requires more disclosure. We've talked about the reasons why that's the case, and that IFRS is moving in the direction of increasing disclosure requirements. So when we were talking about fair value, we mentioned that there is a relevance and reliability trade-off when it comes to measuring with fair value versus historical cost. So relevance, we know, is a concept out of the conceptual framework that basically means that the information would make a difference to a financial statement user. Before the most recent version of the conceptual framework, reliability was a component of the conceptual framework. It's now been replaced with faithful representation. So relevance, reliability, another way to think of that would be a trade-off between relevance and faithful representation. So we know that the definition of faithful representation means that the item or transaction represents what it purports to represent. In other words, it's verifiable, it's objective, and so on. So the IASB tends more toward fair value, and they are prioritizing relevance over reliability or faithful representation, where the FASB is more inclined to go with the traditional historical cost method, which is more about relevance or faithful representation, reliability or faithful representation over relevance. So some of the reliability challenges with fair value, we've talked about the fair value hierarchy and how a level 1 fair value number is really ultimately just as objective and as good a faithful representation as historical cost, but it requires being able to get a direct quote from an active market. So if you have a less liquid market, in other words, a less active market, you may end up using some kind of model instead of observed prices. So that's going to lead to a decrease in your reliability. So, level 2 fair value numbers under GAAP, we say that that is a less active market or a similar but not identical asset. And then a level 3 is a valuation of some other sort, typically a discounted cash flow analysis. So you could have competing valuation frameworks and models that get you different results. All right, so remember that concept out of the conceptual framework, verifiability. It basically means that, two people using the same basic techniques and methods are going to come up with the same results. That's not always going to happen based on what the inputs to those valuation frameworks and models are. So there's always going to be a fair amount of subjectivity in estimates. Remember that if you're going to do a discounted cash flow analysis, it's really a discounted net cash flow analysis. So you've got to estimate your cash inflows, estimate your cash outflows, estimate the period of time over which you're going to be receiving those cash flows, and then you've got to come up with a discount rate, which is also ultimately going to be a discount. The longer the horizon, the more uncertainty that there is going to be in estimating each of those factors. And then, it might be in management's best interest not to be recording an impairment loss. And so they might have incentive to exploit the model choices or the inputs to those models. So lots of subjectivity there unless you've got a direct quote from an active market. And essentially that's what GAAP says. Okay, GAAP says if you can get a direct quote from an active market, then you are going to adjust to fair value. That's a limited number of situations. There are going to be cases in GAAP where you've got to have a fair value number that is a level 2 or level 3, but we're primarily talking about impairment testing there. Definitely writing things down, not writing things up. So more conservative. So in terms of measurement principles and fair value, we're going to talk some about the revaluation practices that IFRS embraces for different kinds of assets. IFRS allows for revaluation of tangible and some intangible assets with consistent application. It is an option, it is not required. But if a company opts for this, unrealized gains and losses are going to go to other comprehensive income and be reported as a component of equity. So we know that, for example, if we had a available for sale debt security and we recorded an unrealized holding gain or loss on that under GAAP, it would go to OCI and be reported as a component of equity in accumulated OCI. In this case, we've got an unrealized gain for purposes of revaluation. it's going to OCI on your comprehensive income statement, and then in your balance sheet equity section, it would be reported as a line item of equity labeled revaluation surplus. And then once again, under US GAAP, we do not have revaluation. So talking some about a couple of different topics in PP&E that differ between IFRS and US GAAP. Initial recognition is very similar. It's going to include your purchase price and all costs incurred to get the asset ready for its intended use. And then you would also have to record an ARO, or asset retirement obligation, if it's something like an oil well that is going to ultimately have to be dismantled and the site restored. So present value of that would also be included in the cost of the asset. So all of that is essentially the same under US GAAP and IFRS. So where we have some difference is in measurement subsequent to initial recognition, because IFRS allows two treatments. Cost model, which is what we do in US GAAP, you record it at historical cost and then report it at historical cost less depreciation charged to date and any impairment losses recognized. Or companies can opt for the revaluation model, where assets are reported at fair value at the date of revaluation minus subsequent depreciation and impairment losses. So some of the specifics of the revaluation model is that you have to elect it for an entire class of assets. It doesn't mean that you have to elect it for all of your property, plant, and equipment. But if we have, let's say, research and development equipment versus manufacturing equipment, then the entire class of R&D assets, if you're going to revalue some of it, you're going to have to revalue all of it. Doesn't mean you also have to do that for your manufacturing assets. You have to revalue on a regular basis. As we said, the increases in value go to OCI / revaluation surplus. When you have a decrease, you're going to reduce revaluation surplus to historical cost, and then you would reduce income in the same way that you would do if you were recording an impairment loss because the cost of something fell below historical cost. So we have an example here. We've got Axle Company purchased a building at a cost of $200,000 on January 1 of 2018. It's recording that building at historical cost of $200,000. The building has a useful life of 20 years, straight line depreciation. There's no mention here of any salvage value, so we're going to assume it's zero. Annual depreciation is going to be $200,000 historical cost divided by the 20-year life, or $10,000 per year. All right, so we bought the asset on January 1, 2018. We would record depreciation annually, 2018, 2019, 2020, $10,000 a year. So at December 31, 2020, at the end of the asset's third year of its useful life, accumulated depreciation is going to be $30,000, and the carrying value is going to be $200 minus $30,000 is $170,000. So if we were looking at T accounts right now, our equipment account would have a $200,000 debit balance, and our accumulated depreciation account would have a $30,000 credit balance. So we're going to report it at book or carrying value, cost less depreciation, which is $170,000. All right, so on December 31, 2020, the company switches to the revaluation model, and they estimate that the fair value of the building at that date, December 31, 2020, is $190,000. So in other words, the fair value of the asset is $20,000 more than the carrying value, so we are going to make an upward adjustment of $20,000. So we're going to debit the building account for 20, and we're going to take the credit to revaluation surplus. All right, so ultimately it would be going into it would be reported as a $20,000 unrealized holding gain in OCI, and then this $20,000 of revaluation surplus in the equity section on our balance sheet. All right, so now we need to revise our depreciation expense because the balance in our building account went from 170,000, I'm sorry, really 220,000 minus your depreciation of 30 or 190. And we're going to take the $190,000 remaining cost to be depreciated and divide it by the useful life of 17 years. So it was an original life of 20 years, and we're 3 years in, so that's 17. All right, so the $190,000, once again, if you've got T accounts, your building account had a $200,000 debit balance. You just debited it for another 20, so your balance there is 220. What's in accumulated depreciation right now is $30,000. So we're essentially revising depreciation expense using the same formula we always would, which is cost or carrying value at the time of the change minus any salvage divided by the remaining useful life. All right, so carrying value at the time of the change is the 220 in the building account minus the $30,000 in the accumulated depreciation account, or 190, and then divided by 17 gives us 11,176. All right, so that was all at the end of 2020. So in 2021, we would have recorded the revised depreciation amount, and we would have done the same thing again at 2022. At the end of 2022, the fair value is $160,000. The carrying amount as of December 31, 2022 is going to be the 190 minus 22,352. That's the 21 and 22 revised depreciation based on the calculations we did on the prior slide. And so the carrying amount is 167,648. All right, so fair value is 160 and the carrying value is 167,468. All right, so at this point, the carrying value exceeds the fair value by $7,648. All right, so we're not going to record an unrealized holding loss. What we're going to do is reverse that out by debiting revaluation surplus and crediting the building account for 7,648. Had the fair value been $140,000, the excess of the carrying amount of the fair value would have been 27,648. All that we have put in revaluation surplus at this point is $20,000, so that's all we can reverse out. So in that case, we would be debiting revaluation surplus for the 20 and crediting building for the 20, and then taking the rest to impairment loss. All right, so the difference here is that the fair value has fallen below the original historical cost. All right, so another difference has to do with depreciation. Like GAAP, depreciation is going to be based on an estimated useful life, an estimated salvage or residual value, and we're going to be doing it annually using one of the standard methods. Remember that GAAP doesn't specify depreciation methods. GAAP says that you have to depreciate in a systematic and rational manner. So when we make a change, as we saw in the previous example we just looked at, where we revise depreciation expense, we do that prospectively, which means we show the effect in the current and future periods. And then one of the differences between IFRS and US GAAP with regard to depreciation is that when an asset is comprised of significant parts, IFRS requires what is known as component depreciation. This is permitted under US GAAP, but it is rarely used. Okay, so this is a requirement under IFRS in a situation when you have something like an airplane, which is comprised of significant parts, which are probably going to be depreciating at different rates. So component depreciation requires that each significant component of an item of intangible fixed asset be depreciated separately, because different components of a large asset may have different useful lives and different salvage values. Applying a composite rate of depreciation to the whole asset might not correctly or properly reflect the periodic allocation of the asset's cost to different periods. Composite depreciation breaks down the asset's cost to different components as far as practical and treats each component as a sub-asset within its own depreciation methods. All right, so here is our example. It has to do with airplanes. We've got Atlanta Air operates a fleet of 10 aircraft, the most recent of which is the Boeing 777, acquired 3 years ago for $300 million, which includes $70 million for the 2 engines. Each aircraft is different, and the planes were acquired over a period of time. Since the company's inception, the engines have a useful life of 20 years, and the overall aircraft has a useful life of 30 years. So we've got 2 significant components with different useful lives. Assume the engine's residual value is 10%, and the other component's residual value is 15% of cost in both situations. Calculate annual depreciation under unit depreciation and component depreciation methods. Because each aircraft is different and was acquired at different times, they must be individually depreciated. Further, because different components such as engines, landing gear, software, cabin fittings, and so on have different useful lives and salvage value, each of those should be depreciated separately. Atlanta opts to depreciate the engine separately and combine all the other components. So what would that look like? So we've got, for the engines, we've got a $70 million cost. We've got a residual value that is 10% of that, or $7 million. So the depreciable amount is $63 million. There's a 20-year life, and so that's ultimately going to be 63 divided by 63 divided by 20 is going to give us roughly 3.1 million a year. The aircraft, on the other hand, has a cost of 230 million. The residual value on that is 15%. 15% of 230 is 35 million. So our depreciable amount is 196 million there, divided by 30 years is going to give us roughly 7 million per year in depreciation. So, if we had just been doing that on the basis of a single component, then presumably we would have taken the $300 million cost, we would have estimated the residual value differently, we would have probably used the 30-year life of the aircraft, and we would have come up with depreciation amounts that are significantly different and also don't really reflect the pattern of consumption, which is what you want to do with regard to depreciation. All right, so investment property. Investment property is not separately identified under GAAP. Here, it's probably going to be something we account for as an asset held for use or for sale. Investment property under IAS 40 is land or buildings held for rental, capital appreciation, or both. All right, so that might be under GAAP what we would refer to as land held for future use, or an available for sale security. So IAS 40 follows the same general principles as IAS 16 on property, plant, and equipment, meaning that you have the choice of using the cost or revaluation model. Typically, these are not going to be assets that you are depreciating. Changes in fair value are going to be recognized in current income and not revaluation surplus. And you must show the fair value in notes with if you use the cost model. All right, so you've got the option of using the cost model or the revaluation model. All right, if you use the cost model, you still have to show fair value in the notes to the financial statements. One of the differences here is rather than taking your unrealized holding gain or loss to OCI, changes in fair value for investment property are going to be recognized in current income rather than revaluation surplus. Okay, because the deal is if you include something in income, it goes to retained earnings. It's going to show up in retained earnings in your equity section. When you take something to OCI, it doesn't go to retained earnings, and that's why you have to have a separate line item for it in your equity section, and that's accumulated OCI or revaluation surplus. All right, so comparing this to US GAAP, we're generally going to require the use of the cost model, although if you have an asset held for sale, let's say we have a piece of equipment that we're holding for sale, you're going to report it at net realizable value, which is fair value minus cost of disposal. And under IFRS, you are going to disclose that fair value in the notes if you use the cost model. That is not required under US GAAP. All right, so biological assets, not a topic that we've spent a lot of time talking about in intermediate. The accounting for biological assets under US GAAP is much simpler than for IFRS. When we're talking about biological assets, we're talking about animals such as goats, sheep, cows, buffalo, calves, and fish. So you could have your catfish farm or your crawfish farm, or you could be raising cows or sheep. Biological assets also include plants such as vegetables, crops, vineyard trees, and fruit orchards. Biological assets keep on transforming. They grow, degenerate, and produce. All right, so US GAAP doesn't really recognize that that's what's happening. All right, US GAAP uses the cost method and ignores the growth of the biological asset. No income is recognized until the final product is sold. Under IFRS, they are going to recognize these assets at fair value, and in doing that, they recognize the change in value over time, where these assets are growing. So they recognize income before harvesting as a result of that. Impairment of assets under IAS 36. This is going to apply to PP&E, intangible assets, goodwill, investments in subsidiaries, associates, and joint ventures. It does not apply to inventory, construction in progress, deferred tax assets, employee benefits, or financial assets such as accounts and notes receivable. All right, so when we think about impairment of assets, the main topics that we've talked about prior to this in your financial accounting classes, PP&E, intangible assets, and goodwill. So the rules are basically similar under US GAAP and IFRS. The tests are slightly different. Impairment under IAS 36 is the amount by which the carrying amount exceeds the recoverable amount, and the recoverable amount is the greater of the net selling price and the present value of the future cash flows. If you think about the recoverability test under under US GAAP, they compare the carrying value to the undiscounted future net cash flows. All right, so impairment is going to be more likely under IFRS since discounted cash flows are going to be used. So in both cases, we are basically doing a recoverability test. We're just not comparing exactly the same things under IFRS and US GAAP. So a significant difference with regard to the impairment of assets is that IFRS allows for the recovery of impairment where US GAAP does not. So under IFRS, you can reverse an impairment loss basically back up to what you originally had recorded. So you can reverse an impairment loss when the recoverable amount exceeds the new carrying value. If changes in estimates used to determine the original estimate, original impairment loss or change is how the recoverable amount is determined. All right, so you can only reverse it up to the carrying amount. You're going to recognize the reversal in income immediately. US GAAP does not allow for reversals of impairment losses. All right, so under both IFRS and US GAAP, when you record an impairment loss, you're taking it to income in the period when you record that loss. Under IFRS, when you reverse the loss, you do the same thing. You recognize the reversal in income immediately. You're not going to be doing that under US GAAP because they do not allow for reversal of impairment losses. So intangible assets in general, a lot of the same rules are going to apply for both US GAAP and IFRS. So when we're talking about IAS 38 intangible asset, it applies to purchased intangibles, intangibles acquired in business combinations, as well as internally generated intangibles. Goodwill is covered separately in a different IFRS number 3. An intangible asset is defined similarly for both sets of standards. It's an identifiable non-monetary asset without a physical substance. It's held for production of goods or services, rental to others, or for administrative purposes. So if an expenditure does not meet the definition of an intangible asset, it must be expensed immediately, except when it's obtained in a business combination. Like US GAAP, purchased intangibles are measured at cost under IFRS, and like US GAAP, the useful lives can either be assessed as being finite or indefinite. The distinction between intangibles with finite life and indefinite life is made in IAS 38. We know that if an asset, an intangible or tangible asset, has a finite life, you're going to depreciate it or amortize it over that period of time. But if it has an indefinite life, there is no period of time over which to amortize or depreciate, so you can't. So typically, if you have an intangible asset with an indefinite life, what you're going to do is amortize it on a regular basis. So certain types of intangible assets are typically going to be acquired in connection with a business combination. These are going to include patents, trademarks, and customer list. Under both US GAAP and IFRS, those are going to be measured at fair value, even if they hadn't been previously recognized by the company that you're buying. Once again, you're going to have a finite or an indefinite life assigned to those assets, and we know that there is special treatment if an for in-process R&D. All right, you're going to capitalize it when certain criteria are met. Otherwise, major differences with US GAAP. IFRS allows for some development costs to be capitalized, where US GAAP expenses all research and virtually all development. There is an exception for software cost under US GAAP, but for the most part, we expense all R&D. Under IFRS, the criteria for development cost capitalization includes technological feasibility of completion. So we feel like we have the technology to be able to actually complete this project. We have to be able to complete the asset for use or sale. We have to have the ability to use or sell the assets. So basically, in order for something to be classified as an asset, it's got to have future economic benefits. And so it's not going to have future economic benefits if you can't complete it, if you don't intend to complete it, and you don't have the actual ability to either use it or sell it. All right? So in some cases, those probable future economic benefits are going to be generated by selling it or by the market, but it could also have internal use. All right, so you have to have the available resources as well as technology to complete the asset for use or sale, and you have to be able to reliably measure your development expenditures. You have to be able to differentiate those from your research expenditures. Once again, for these internally generated intangibles, revaluation is allowed for finite-lived assets if a direct quote from an active market is available, or in other words, a level 1 fair value estimate. In terms of impairment of intangibles, once again, these rules are going to be somewhat similar to US GAAP. You're going to do a recoverability test. Remember that your recoverability test for plant and equipment is the same for a finite-lived intangible asset, such as a patent. For indefinite lives intangibles and goodwill, you're not going to be you're not going to be amortizing them. You are going to impairment test them annually under both US GAAP and IFRS. And then under special circumstances, IAS 36 does allow for reversals of impairment losses for intangible assets, except for goodwill. Goodwill is not subject to impairment loss reversal.